What is going on, my good old friends of YouTube? It is your boy Stas here. Welcome back to another video. So we got to break down some stocks that I believe are pretty undervalued right now in the stock market that we're currently in August of 2022, the end of August here of 2022. So if you guys find value, hit that like button, subscribe. Make sure to get your 10 stocks from Moomoo. Each of those could be valued up to $2,500. All you got to do is use my link down below, deposit at least $100, and boom, you get your money. And you could also get 12 stocks from Webull, up to 12 stocks with any amount deposited. All of those are linked down below. And with that being said, let's dive into the video. So stock number one is Etsy. And by the way, guys, we're going to talk about, I think, 5-ish, maybe actually 6, almost, maybe actually 7 stocks, maybe 7 stocks. I didn't actually count before making the video. I probably should have done that, guys. But we're going to break down a bunch of stocks and we're going to go through charts very quickly, and we're going to look at some numbers. So with that being said, let's dive into it. Etsy is stock number one, which is down massively, as I'm sure you guys know, in the past couple of months here. Etsy hit $307 back in November of 2021, and it's roughly at $120 now in the month of August of 2022. So in other words, it is down from 307 to 120. It is down over 60%, guys, which is just abysmal for Etsy. But you got to ask yourself, is Etsy going out of business? Probably not. Are they consistently profitable? It looks like here over the past couple of years they have been. So a profitable company, you got to look at it more, not more seriously, but they've proved more than a company that's just come out, they're losing a bunch of money and they're still trying to get profitable, right? Or at least that's how I personally look at it. Let me know your thoughts down below in the comments. So Etsy is profitable and it's down 65%. So let's jump over here to Yahoo Finance and see what's going on the Safari tab. So here we get to see a little bit more info on Etsy. It's currently a $15 billion market cap. As of right now, the P ratio trailing 12 months is a little bit over a 40, which is a little bit high, but you guys got to realize when you're looking at growth stocks, you're going to pay a premium. You're going to pay a higher multiple when you're buying a company that is growing faster than a company that is not growing that fast, right? You're going to pay more for higher growing companies. So let's see now on the financials tab here, how much are they growing? So in 2018, they did $600 million of revenue. In 2019, they did $820 million roughly. In 2020 is when they blew up. They over doubled up their revenue to $1.7 billion. And in 2021, they did 2.3, and now trailing 12 months, $2.4 billion. So this company is growing very quickly. We're talking compounded growth. I mean, over the past couple of years here, if I had to take a guess at it, I don't have the exact percentage number here, but just looking at these numbers, glancing at them, I would say anywhere from 50% on average. I mean, they doubled up their revenue from 19 to 20, and even from 20 to 2021, their revenue grew what? 40%, 50, whatever that ended up being, from 1.7 billion to 3.5 billion. So they're growing revenue nicely, and again, they are profitable based on what I saw on ThinkOrSwim here. So what do you guys think? I think Etsy at this point, maybe it's not bargain basement value quite yet, but it's at a point where you got to ask yourself, is Etsy going to go out of business? Most likely not. It's profitable. It's in an industry that's growing. I think they have a pretty decent economic moat. And honestly, if Etsy gets back under, let's say, $100 a share, maybe it gets back towards the 80s, 70s again, which who knows, that might not ever happen again. But let's say it does, that would be a point where it might start getting to that bargain basement value. It might be truly extremely undervalued. But at these levels here, you could argue it is a little bit undervalued based on your assumptions, but maybe it's more near fair value, again, depending on your assumptions. So Etsy, I like it. Number two is eBay. And when I saw the price to earnings ratio on eBay, guys, we'll take a look at it here in a second, I was like, what the heck? We got to look deeper into that. So eBay is down from $81 a share. Now it's roughly at $50 when I'm filming this video. In other words, it is down about 40% in the past couple of months. So eBay has not been doing well, clearly in a bear market. And for me, guys, I'm a customer of eBay. Well, not really a customer. Well, I guess I am a customer in the sense that I use the platform, but I sell on eBay. Not really much anymore, but I used to do it a lot years and years ago, especially when I was in college. Now I just sometimes sell something on eBay if there's something around the house that I'm not using anymore, and I'm like, oh, I can make $50 on this or get some money back, $100 on this. For example, there was this camera that I bought. I wasn't using it, haven't touched it in a year and a half. Sold it on eBay, boom, $450 like that. Made $450 like that. And obviously, I bought the camera for $700, so I lost money on the camera, but it's nice to go on a platform and sell your crap, get some money for it, and that's what eBay is, and I think it's a great business. Sure, they're going through some short-term pain right now, but if we look here on Safari, and let me move my face very quickly, guys. Thanks for the patience, guys, as always. So here we have, oh, this is still Etsy. Hold on, let me get over here to eBay. If we look at eBay's trailing 12-month PE, this thing is a 2.6. I mean, that is as low as I've seen in a while. And we have to look into the nitty-gritty. We might not have time to do that in this short YouTube video but the PE, we got to look deeper into that. The dividend right now on eBay is about 1.8%. And the market cap is $27 billion. And one thing worth mentioning is when there's a super low PE on a stock, it could be a value trap. Meaning it's extraordinarily cheap on a PE basis, which attracts value investors, but maybe the business, it's not going to work out. Or maybe the fundamentals are deteriorating and you don't even realize it, or maybe you don't dig deep enough and you fall for the cheap PE, and then you end up getting into a stock that ultimately keeps going down, or never ends up panning out like you thought it would. So eBay, we have to see here. I think the financials will show not much growth. Yeah, look at that. They haven't grown much at all since 2018. So that's a big reason why the PE is low as well. Look at this. In 2018, they did $10.7 billion in revenue. Same in 2019, and then in 2020, they dropped to $10.2 billion, and in 2021, they did $10.4. So pretty much flat revenue growth. Honestly, it's been declining a little bit for eBay here over the past couple of years. So if they're able to get their crap together, this could be a good turnaround story. It's not there yet, that's for sure. We're not seeing a big improvement, but I mean, it's definitely one that's cheap right now and worth watching. And you guys also have to watch the banks. Have you guys seen these banks? JP Morgan, Bank of America. These are down a ton. If I pull the ThinkOrSwim up, you can see JP Morgan. And mind you, as the markets have been recovering here the past couple of weeks, JP Morgan really has not recovered that much. Sure, it's gone up. All right, fine. It's gone up about 13% from the recent lows. But a lot of stocks out there are up way more. And look at JP Morgan's chart. I mean, it's still down a ton from the recent 172 high. JP Morgan's down about 30%. And we have Bank of America down a good chunk, about, let's see here, 25%. So both of them are in a bear market. And I've said this before on my channel, guys. I'm not the biggest bank investor, but they're looking decent. When we're looking at the overall market, right? When we're looking at different industries, you got tech, you got energy, you have banks, you have healthcare or financials, healthcare. a lot of them are overvalued. Tech's pretty overvalued for the most part. Healthcare has gone up like crazy. Same with energy. Banks, on the flip side, financials, they have lagged. Let's be real here. They have lagged 100%. And again, I'm not the biggest individual bank investor guy. I've said that before time and time again on the channel, but it's hard to ignore them when they are, behind the markets and they're paying some juicy yields and they're behind a bunch of other industries. Look at JP Morgan here. If I pull it up, you're going to be like, oh, okay, I see what you're saying, Stas. Look at that. And typically banks do trade at a lower price to earnings, but sheesh, look at that. JP Morgan's under a 10 price to earnings right now. Dividend yield is 3.3%. Yahoo Finance thinks they're near fair value, which I agree with 100%. I don't always agree with these different sites that I use on the channel, guys, and I'm open with that. But in this case, I agree with them on that. So this is one that I might have to throw some money at. Maybe at some point later in 2022, maybe early 2023, depending on certain factors. JP Morgan's, one that I'm looking at. Bank of America's another one. When I'm thinking cream of the crop, banks, financial companies, I'm looking at JP Morgan, Bank of America. Maybe something like a Capital One even I might look at. That's one that I have to do more research into. Maybe we'll look at that here in a second. Right here we have Bank of America, 11 PE. Their dividends 2.4%. Their market cap is a little bit under $300 billion. So I like these. The banks look pretty decent right now, in my opinion. Let's see what Capital One's looking like. I haven't actually looked at that stock or done much research into it in a long time. What the heck's the ticker? Is it 1? I don't even know what the ticker is on this. No, this is it. COF. COF, Capital One Financial Corporation. They pay a 2% dividend. P's a 5 right now. Oh my goodness. This might be one that I got to look into and see what the competitors' price to earnings ratio is and dive into that. So banks, eBay, Etsy, 100%. You guys got to watch those. Square is another one which is down tremendously. Well, I guess this one's known as Block now. The market cap's $51 billion. Price to earnings ratio is non-existent because they are not a profitable company. But if you look at, and for unprofitable companies, guys, I like looking at price to sales. If you look at their price to sales ratio, where is it here? Let's see. Last I checked, it was low, at least in my opinion. Price to sales under a 3. Trailing 12 months, it is a 2.85. So that's pretty low considering Block is growing revenues pretty freaking massively, if you ask me. In 2018, they did $3.3 billion. 2019, $4.7 billion. In 2020, they more than doubled up to $9.5 billion. And in 2021, they did $17.6 billion of revenue. And if you guys take a look at the stock, it is down a whopping from 290 to now mid-high 80s, low 90s. It is down 70%. So, I mean, there is risk with the stock, 100%. It's off and on. Well, here it says it is profitable. I got to look deeper into it. Overall, ThinkOrSwim says they've had profitable quarters here. Yeah, they might be profitable. I don't know why the PE is not showing on Yahoo Finance, but overall there is risk here because they do have cryptocurrency exposure. So you gotta ask yourself if that's something that you want to be a part of. Which some people, if you don't want to be a part of that, completely okay. This is not financial advice. You guys are up. You're free to do whatever you want with your finances. It's all up to you at the end of the day. So the last group of stocks here that I want to talk about are the Chinese stocks. Yes, the Chinese stocks, guys. Alibaba is one that I own, my biggest individual Chinese stock holding, and it's down massively, and I think it's very undervalued. I've said this time and time again. It's down 71%, and if we're looking at okay, fine, China risk is huge. We get it, but the China risk aside, if we're looking at financials, if we're looking at just ratios, Baba, all these Chinese stocks, companies are ridiculously, disgustingly undervalued. We're talking Alibaba, we're talking JD.com, we're talking Tencent, we're talking, what else do we got? Baidu, these are very undervalued. But obviously, the reason why these stocks are trading at such low multiples, if I pull up Yahoo Finance here, you'll be able to see it. The reason why we're trading at such low multiples is because of the Chinese risk, obviously, right? No freaking kidding. Trust me, guys, if there was no Chinese risk or, government risk over there, this would not be at now it's at a 42 P. But you get the point. Alibaba was at a much lower P, last time I checked, but now it's at a 42. But I think it was at like a 16 at one point. If there was no Chinese government risk, these stocks would be a lot higher. It's very obvious. So with that being said, I guess that is a good spot to wrap up the video. If you found value, as always, smash that like button. Make sure to subscribe and check out my Patreon. If you guys want all my buy, sells, call outs, morning videos, all that good stuff is on Patreon, link down below. And make sure to get your 10 stocks from Moomoo with a $100 deposit and your 12 stocks from Webull with any amount deposited, guys. All those links are down below. And just know all those links help out the channel. And without you guys, this wouldn't be possible. So cheers. Thanks for watching. As always, I'll catch you in the next video. Peace out.